The following is a presentation of TFNN. It is now time for Trade What You See with your host, Larry Pesavento. Now, Larry Pesavento.
Okay, good morning, folks. I thought I would start the show today for TFNN by posting a study that was done during 2009 and 2010 by FXCM. It's one of the larger Forex banks. And what they did was they examined 12 million real trades. These 12 million, that puts you in a pretty good statistical category. And over a 2-year period during 2009 and 2010, and it basically showed that the traders that were trading through there were right 59% of the time on their trades, and yet they still lost money. And the reason for their losing money is they lost twice as much on their losing trades as they made on their winning trades. In other words, they reversed the process. You're supposed to make more money on your winning trades than you do on your losing trades, and they reverse this process. So there's a couple of things on this study that really are important. I've seen it before, but I think it's worthy of really talking about it, because a lot of folks out there are new, and even those that are not new still make mistakes. We all make the same mistakes over and over again. The old adage is the smart man learns from his mistake, but the wise man learns from the mistakes of others. So let's try to learn from some of these mistakes here. Basically, what it's showing is that they reverse the process. Instead of winning more dollars on each trade than they're losing, they're reversing that. And there's two reasons for that. They don't go into this in the report, but I think I know what these are because I've looked at these studies over the years. And the main reason that most people lose more than they win is the fact that they do two things. One is they fail to put a stop-loss order in to protect themselves. They fail to focus on the amount of risk that they're risking at any one time. The second thing that they do that is really negative for trading is that they watch the machine all the time. They watch the ticks go up and down, and they watch the little patterns go up and down all day long, and that is very, very tiring, not only physically but also emotionally, and it leads to mistakes, because if you're long, you focus on the upticks, and if you're short, you focus on the downticks. That's just a natural phenomenon because our bodies are meant to, stay away from pain. So if we focus on the upticks when it's going up, that makes you give you a nice, warm, cushy feeling. But if you're long and it's going down, you don't like that, and that's where they get into problems. So there's the main thing. The good part about this is that, 59% of these people, had a profit at one time. If they would learn to manage the trade a little bit better and maybe not be as greedy or have some type of a trading plan, they could do a lot better. But the fact that it was such a large sample size, 12 million trades, that really gives you an idea of the statistics behind it. And also, it should, those of you that are just new to trading, it should give you hope, because you can see that there is the possibility of making the money, but what you have to do is you have to have a strategy and a money management and risk control, to profit from it. That's just part of it. We use pattern recognition, but, we also have to use, risk control. The main thing you should focus on when you're trading is the amount of risk that you're taking at any one time. That's the only thing that you can control, is the amount of risk. You cannot control how much you're going to make on a trade. You'll never know whether the trade is going to be profitable or not. So these are the things that you have to, really focus on in order to, learn to do this correctly. That's what that's the bottom line. There's nothing easier than that, in my opinion. Now, today, folks, is a very, very important day in history. If you'll remember, back on March the 9th, 2009, just 4 short years ago, when we were at death's door, politicians were meeting, and they were trying to save the banks with their TARP program, which they did. And then later on, Mr. Bernanke came in and added QE1, QE2, and QE3, and that has propelled us up into a big bull market, which everyone is watching, at this time. So the main thing that I would like to talk to you about is that when you look at this long-term chart of the New York Stock Exchange Index going back the last 18 months, it is still not made the 786 retracement of the 2007 high. It's very close. It's within about 5 points of making that exact 786 retracement. So that's where we are looking at that. I mean, the Dow Jones is getting all of the press, and we're having the same type of problem, with the NASDAQ, that we are, not making, a new high in the NASDAQ also. In fact, the NASDAQ has one of the more ominous pictures for technical analysis that technicians use, and that is the head and shoulders pattern. And it's a very symmetrical one where the 1.27 high is exact from the left shoulder, and then the right shoulder is coming in at the 786 retracement that is almost exactly the same price as it was last March at the 27.99, 2800 level. So this is a very symmetrical head and shoulders pattern. That doesn't mean that it can't fail, because these things do fail. But the overall broad market, I mean, the New York Stock Exchange Index and the S&P has made a marginal new high. But the one that gets all the press, of course, is the Dow Jones Industrial Average, and that's the least important of all of them. I keep telling you folks this, but it is, because it's price weighted. In other words, IBM, is more than Microsoft because it's higher priced. So that's the main thing that we want to keep in mind. That's where we are at this particular time. Also, we are making a what I think is a triple bottom in the VIX index. We've had some really nice moves here in the VIX as far as volatility since December the 31st, and now we are potentially looking at 3 higher bottoms. As long as this $12 level in the VIX can hold, we have a pretty good chance that this could be it. When I look at all these charts on the indices across the board, it's very, very difficult for me to think this is a new breakout to a new secular bull market. We're not seeing any of those things that I think are necessary to make that happen. And one of them, I think, is quite important, and we've talked about this several times. But this next one comes from Sherm McClellan's group. He's since passed away, but his son is running the show now, and it's the price of copper over the last several years, and you can see the tremendous divergences that we're having in the price of copper. And we've talked about this, over many, many sessions now, that this is usually not a very, very positive thing to have happen, if you're in a bull market. Now, that doesn't mean you're not going to be in the bull market, but this tells you it's something that you should be aware of. Folks, if this is a new secular bull market, there's a stock out there that is really oversold, and it's a very popular stock, and that's Apple. And we're only $22 away from what we think is that's 5% of what we think is the price objective at $394. So if we get anywhere near that level, and this market does, make a secular, move to the upside, then Apple would probably be the one, to take a look at. Because technically, it's been absolutely perfect. It's done everything that you could ask a stock to do, but it has not moved as yet. And I think that's only because of the fact that we are, in a situation where we have a, market that has just been beaten up so bad, it doesn't have any friends. But eventually, Apple will, come to the forefront and have a good rally, if nothing else. I mean, they've got, $100 billion in cash, I guess, but maybe that's not enough. Now, I wanted to talk because today on Bloomberg they were focusing on how everything was so wonderful in China, and I'm going to put the ETF for the Chinese market up there. That's the FXI, and you can see that it has had been diverging badly from the S&P cash. It's basically in a very strong downtrend since 2011, but the downtrend on a long-term basis extends way back to 2006. So it's been in a tremendously a tremendous bear market for, a very, 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 very long time. So there's another, it's my second, but there's lots of reasons. But I'm just saying, just be careful up in here. I know it makes a new high every day, and everybody walks out with their tambourines, and they're blowing their little whistles, and they're all walking down the street. But, folks, go back to March of 2009, and you remember how we were at death's door. If you remember Paulson walking down the halls of the Capitol building, that was Henry Paulson, Secretary of the Treasurer, and they were trying to figure out how we were going to save the banks because Citibank was trading for approximately 30 cents a share, I believe. And, there was just a, disaster everywhere. And now, Camelot has returned, and this is the time where you really want to be careful in here. So, that's basically it. This reminds me a little bit, but not quite as much as the year 2000, right after January of 2000, when the market was still going up, and I was warning people of, that was an easy one to call because of these stocks were moving 20 and 30% a day, and, that's it. Someone asked me a question of why I don't make the comparison between the 1830 to 1840 area again, and the main reason for that is that on that March 15th, let's rephrase that. On April the 15th of, I believe, 2008 is when we had that monster conjunction of that had never been broken before. Now, the Dow has broken that, but the New York Stock Exchange Index has not broken that. It has not gone to new highs. It's not even made the 786 retracement. The reason why I don't talk about it very much, for two reasons. One, it's not working, and I don't want to take any more heat than I absolutely have to. And the second reason is it's just a very, very long-term cycle, and it could take, maybe a couple of years, and we're already into this thing. We came down into 09, and then we had this huge, 4-year bull market, and under any circumstances, it was a bull market. I remember that was a big move for me in 2009 because I said this was going to be the biggest short covering rally that the stock market had ever had, and it in fact was that. And but right now I'm just saying, just be very, very careful. The other thing that I think is important to remember here is that these lunar cycles have been working really well for many months. For the last 2 months, and that's been a long time. We haven't had anything really working very well on the lunar things. I mean, we had a really good move on the solar eclipse of November the 15th. That was the bottom at the 618. Then we had that one on New Year's Eve on the 31st. And then since that time, there's been very little. We've got to take a break here. And when we get back, I want to cover the Japanese market, and then we must cover, we're going to spend a lot of time on bonds and notes, folks, because they have turned out the lights over there.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box. You take a hands-on approach to managing your investment strategy. You're always looking for the next trading opportunity to magnify your perspective. Direction Shares connects sophisticated traders with a powerful array of ETFs from a wide range of asset classes. The markets may go up and down, and you want tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain this, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor, Foreside Fund Services, LLC. McEwen Mining is a high-growth, mid-tier producer in the Americas with a market capitalization of $1 billion. Experienced mining executive Rob McEwen, as chairman, CEO, and president, owns 25% of the outstanding shares of McEwen Mining and has put in place an ambitious business plan with the goal of qualifying for inclusion in the S&P 500 by 2015. With $70 million in cash and liquid assets as of the end of 2012 and completely debt-free, McEwen Mining is poised for growth. Production in 2013 forecasted to grow at 24%, reaching 130,000 gold equivalent ounces, and over the next 3 years, McEwen Mining projects that their production will increase to 290,000 gold equivalent ounces, almost a threefold increase from last year's totals. If you'd like to find out more about McEwen Mining, click on their banner on the front page of TFNN.com or check them out on the NYSE or TSX under the symbol MUX.
What type of investor are you? Conservative, moderate, or aggressive? No matter your investor personality, your overall portfolio should reflect your financial goals, time horizon, and your risk tolerance. Help ensure your portfolio is appropriately invested with an asset allocation plan from Morgan Stanley Wealth Management. Simply picking the right stocks is not enough. Research has shown that choosing the right proportions of stocks, bonds, and cash is essential to the success of your long-term investments. Morgan Stanley believes a carefully selected portfolio can lower volatility and increase investment return potential. Find out about what an asset allocation and a Morgan Stanley Wealth Management financial advisor can do for you. Call Angela O'Brien, First Vice President and Financial Planner of the Clearwater, Florida branch at 727-441-6108 today to discuss your personal financial needs. Asset allocation does not assure a profit or protect against loss in declining financial markets. Investments and services are offered through Morgan Stanley Wealth Management, LLC. Member SIPC.
This segment is brought to you by Great Panther Silver. For more information, just click the Great Panther Silver banner on the front page of TFNN.com.
Okay, we're back, folks, and we're going to take a look at the Nikkei Dow. I put the long-term chart up there going back to 2008, and we are now at a 786 retracement of that move. And we made a beautiful ABCD pattern here in the Nikkei. And, of course, everything in the news now is that everything is okay over there, and they're going to, everything's going to be just peachy keen from what they said on Bloomberg today. But we'll see. This is, the pattern is completing. We'll see what happens, the remainder of the week. But the pattern is, certainly done what it is supposed to do. Now, we do have a game changer out here, folks, in my opinion, and that is the Treasury bond market. We've done some serious damage. We talked about this several weeks ago, the fact that we had made that perfect 61% retracement at the 42 level. Then we rallied up for about 3 weeks. But the important part of this is the fact that the rally could only make the 382 retracement. In the Treasury notes, the shorter term ones, the 5 to 10 year, they made the 61% retracement. So this is a tremendous difference. And the long bond, this 30-year now, has now broken down below the 61% retracement. The 786 comes in another point lower at the point and a half at 139.25. But the target now on this takes us down to last year's lows in March. What this means is that interest rates are starting to move higher in the marketplace. Now, Federal Reserve is artificially holding interest rates near zero to prop up the economy. They say they're propping up the economy. What they're doing, it appears, is they're propping up the stock market. The economy doesn't seem to be moving much because GDP is not moving very much, and sales are not moving very much, and the jobs are moving a little better, but that's primarily because so many people are dropping out of the sales force. At least that's what the people are saying. All I am saying is, but based on the price chart, this market has started to to roll over. We've had lower tops since July. We had one in November. We had another one back in February. One in February was a very pathetic 382 rally. That's what we're looking at. We're looking at higher interest rates coming in here. Now they're not going to go. Interest rates are not going to go from 0 to 3% right away. It's going to take a long time, for this thing to unfold, the way that we've been looking at it. But remember, this is a very, very long-term cycle that we've been watching. This is one that goes back to 1981. So we've been watching this for 32 years, and every year, we've had lower rates all during that time. There's not been a quarter where we haven't had lower rates. And so if this market does start to come down, we could easily, have a tremendous move. Folks, remember when Treasury bonds started trading in 1976, they were trading at around 75. The low for the 75, the low of the bonds was around $56. That means that you could have bought a $100,000 30-year bond for $56,000 and held it to maturity, and that would have, but that's when rates were 12 and 14%. But now we're talking about rates on the long bond near 3%. So that's what we're looking at as far as where these bonds, where they've been, where they're going, and so we could have a tremendous move. It's my opinion, and this is my opinion only, is that Bernanke has done an experiment with this QE1 and QE2 and QE3. They're pumping all this money in. The question is, how do they unwind this money? That's going to be the $64 question. It's very similar to what happened to long-term capital and John Merriweather, back in the early, I think it was late 90s or early 2000s, when they had all these hybrid guys, that made money hand over fist, except when they tried to unwind the position, and they were unable to do that, and it led to their ending the company at the end of the bankruptcy that had to be taken over by the Fed just to protect, the liquidity of the market. So this is something that we've started in the bond market. I really believe this is a game changer that we're looking at here. There's several charts in here that I think are really important. I'm going to post the one on the T-notes going back over a weekly basis. And what it shows on this chart is the fact that I inverted the S&P 500 over the Treasury bond market, and you can see, since the QE started, that there's been the widest divergence in stock prices versus bonds that we've ever seen. Anyway, this is what we've got. We've got to take a little break here, 877-927-6648, and then we will talk some more about these bond markets.
Just recently, on December 28th, Market Insight subscribers were advised to go long the QQQ, the NASDAQ 100 ETF, on December 28th at $63.91, and only 2 trading days later, after a huge jump in the markets, Market Insight subscribers were advised to sell the QQQ at $66.64 for a $2.73 or 4.27% profit to start off 2013. At the same time, Tom O'Brien had advised his clients looking for a more leveraged trade that they could have initiated a position in the QLD, the ProShares Ultra QQQ ETF, and over the same 2 trading days, Market Insight subscribers were able to lock in a $4.48 profit or an 8.47% gain in just 1 trade. Get your 2-week free trial to Market Insights today by visiting the front page of TFNN.com. Cancel at any time during your free trial and pay nothing. Don't miss out on the next great trading opportunity in 2013. Act today. Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's Nadex.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Recently, Basil Chapman has had some outstanding trades in his newsletter, The Opening Call. Each morning by 9 a.m., Basil uploads his newsletter to the TFNN servers so that his subscribers can access his expert trading advice. Basil gives his take on the direction of key indices and updates any active trades that his subscribers are currently in. Just recently, Basil's subscribers closed out a short position in Chipotle Mexican Grill, CMG, for more than an $86 profit per share, over a 20% gain in just one position. If you'd like to try out Basil Chapman's newsletter, The Opening Call, then visit the front page of TFNN.com and click Trading Newsletters. There you'll find Basil's newsletter, The Opening Call, where you can request a free sample copy. Also, don't miss Basil's program, The Tiger Technicians Hour, Monday through Friday, 11 a.m. Eastern, on TFNN.
Tom O'Brien's weekly newsletter, The Gold Report, has helped subscribers for over 10 years navigate the high-risk world of exploring and producing gold companies. And now's a great time to sign up for a free month-long trial to see the kind of insight that Tom delivers for his subscribers on a weekly basis. Every Monday, Tom O'Brien issues a quick update on the metal market, giving you his take on the HUI, XAU, GLD, dollar, bonds, and much more. Tom follows Monday's update with a full gold report, which is delivered to subscribers Tuesday afternoon with detailed coverage of 24 separate gold or metal stocks, as well as another 10 to 15 stocks that he lets you know are on his potential watch list. Get your month-long free trial to the Gold Report today by visiting the front page of TFNN.com. Don't spend another year navigating the metal markets on your own. Act early in 2013 and make the most of your gold and metal market investments.
This segment is brought to you by Crocodile Gold. For more information, just click the Crocodile Gold banner on the front page of TFNN.com.
Okay, folks, I posted, someone asked a request to take a look at the long-term chart of the New York Stock Exchange Index that we have going back to 2007, and I put that in there and into Tiger TV to take a look at it, and it shows, the patterns that are forming right now. We have a 3-drive pattern, we have a Gartley pattern at the 786 level in the New York Stock Exchange Index, and that's the true market. That's thousands of stocks, the largest stocks, cap-weighted in the world. I think there's 6,800 of them, as I recall. And this is the true stock market. The Dow is certainly not, and nor is the Nasdaq. And but anyway, that's just some information of what I look at, because that's the real market. That's how I was taught to look at the market, was with the New York Stock Exchange Index. Even the S&P is only 500 stocks, so and it's cap weighted, so that really large cap stocks in the S&P can move a little bit. But when you've got thousands of stocks, you can't. There's not one stock that can do it. They have to move in unison, and they follow the numbers, incredibly well. The ratios and the patterns that we look at. So that's what we're following. Now we want to get back to the Treasury bonds again. I mentioned the fact that we did break below the January low at the 42 level. That sets up a very bearish scenario on the Treasury bonds. And so we have to be, really, really important that we're watching this, very, very closely. Now, I want to show the difference between the Treasury bonds and the Treasury notes, And the reason why is on the long-term weekly, we were at the 786 retracement in the Treasury bonds based on the continuation chart. So with the wide range that we had down on the weekly basis last week, we haven't had one of these in a very, very long time, and this sets up a price target, far, far lower, than what we're looking at now, which means higher interest rates. Now, of course, stock markets can go up in the face of higher interest rates if there's an expectation that the higher interest rates are going to bring more sales. We'll have to, wait and see if that's going to be the case, but we don't really know for sure. But there's another thing that you have to consider here, another part of the bond market that is very, very large and very, very important, and that is that the muni bond market has left several gaps in the market. They've broken down, very, very badly. They've had lower tops for quite some time now, ever since December, and also the rallies were also very, very meager. So we're seeing increased prices for muni bonds, which means the rates are going up in muni bonds. I said that wrong. The prices of muni bonds are going down. That means that the rates are going up because it's an inverted price. Because when prices go down, that means the yields go up. So that's what we're looking at, with the bonds. So I really think we've had something really, really big happened here. Once we broke that 142 level in the bonds and the 131 level in the notes, that told us that, we talked about that quite a while on this show because I've been watching for that move. The fact that we didn't come out of there very strong, I really was anticipating that we might get to 149 in the June bonds where it would give us a, head and shoulders pattern, but it weakened very, very quickly, and that's it. The $64 question is when will the rest of the market realize that something really sinister is staring in our face right now, and will they be able to do anything about it? How are they going to extricate themselves from these positions that they put on? Because, $1 trillion here, $1 trillion there is a great deal of money. You just don't go to the market with that. You have to unwind that over, weeks and weeks and months, and there's just there's not much else that you can, really do about it. Going back to the muni bond market one more time, we're down again today, which makes, I think, the 10th day in a row that we've been down in the muni bond market, and it sets up much lower levels on just a price swing of AB equals CD. So there's a lot of things happening in the interest rate market right now. They haven't happened in the stock market as yet, but the interest rate market has raised its head, and believe me, that the bond market is at least 6 times bigger than the stock market. So we're talking about serious money moving here, folks. This is not just a few billion or trillion here or there. We're talking a lot of money, and so this is why you want to be watching what we're doing. As we're talking right now, during the break, my alert went off that the New York Stock Exchange Index had just hit the 786 retracement at 9066, and I did a quick hourly chart on it over the past month, and we're making that 5-wave reversal pattern that we've looked at several times in the past. So we'll see, if this is going to be a key turning day, or not. We'll just have to, see as we go. It's just amazing. The Nasdaq is just, barely unchanged on the day, with the Dow up, close to 30 points. So that's a very important thing that makes a lot of sense. Now, there's another. We're at a really lot of key levels, and I want to go over to gold and silver because we've been talking about this market for quite some time, and that we held the 1560 level twice now in the last 2 weeks. And then it has bounced from there. Silver has also done a really nice move as far as holding up the price that I'm trying to find the chart. If you give me a second here, there it is. Last Friday when we had the big move down in silver, we had a really nice head and shoulders pattern form exactly at the 61% retracement down at that 28.40 level, and we rallied almost $1 an ounce. We need silver to get above the $30 an ounce level, and we need gold to get above $1,600 an ounce in order to kick in the bullishness if it's there. Now we're in the same situation in the gold and the silver as we were in the Treasury bonds. With the bonds made that 61% retracement at the 142 level, and they did rally for 4 or 5 weeks. But they rallied for 3 weeks, but they didn't go anywhere. They only made a 382 retracement in the bonds and 61% retracement in the notes. So it's very important that the gold gets out of here and starts to move higher, because if it doesn't, that's telling me that there's a cycle low that hit at 1560 because it was the 786 retracement. But if we start going below that 1555, 1550 level, that tells me that that cycle is breaking down just like it did in the Treasury bonds, and that's going to yield to lower prices. That's the bottom line of how the cycles work. If they don't go up, they've got to go the other way, and so you've got to have two scenarios that you're looking at as far as which way it's going to go. But the gold has held so far. It had a really strong test on Friday. It went down there and held the 786 very strongly. The silver, which has been a little bit stronger than gold recently, held the 61% retracement. So all of that is still good, and they still look good. The gold and silver stocks that we looked at last week and the XAU, all of that has held up. The XAU is down, marginally today, but, it had a really strong move off the bottom, as did the gold-silver index. No, that's the gold bug index, and it held, relatively well too. So as long as these lows are holding, everything looks okay. Is that if they fail, therein will lies the problem, because if they don't go up, they only go one other way, and that's down. And so you have to be able to, figure that into the equation, when you're doing it. I wanted to put one other chart. This is my own chart. The other one I put in was from Sherman McClellan, from the McClellan oscillator, but I wanted to put my own chart that I have for copper and the S&P, and it really shows this tremendous divergence that we're having right now. The only reason I bring this up is that copper is so important to just anything that is built electronically, cars, batteries, just about everything that is electronic and moves has copper in it somewhere. The computers, the iPhones, all that stuff. And the problem is that it is going down and not up. And if they were building that many new products and stuff, you would think they would be buying more copper. And in China, they consume 40% of the world's copper, and their stock market is still going down. It's had a good rally, of course, off the bottom, just like we were pulling them up, but they're so far below their 2006 highs that it's not even a 382 retracement in the Chinese market. So there's things out there that are a little different that you want to be afraid of. The other thing is that there's awful lot of bullish sentiment out there, folks. I mean, as high as it has been, since 2007. And so you've got to be extremely careful. I know every 5 minutes they have a little clock on either CNBC or Bloomberg showing that the market is making a new high and market is making a new low. But remember, back in 2009, they weren't showing that market was making a new low when we were collapsing down into those lows into October, November, January, and then into March. They were not doing that. And the reason why is they don't sell many advertisers if they're talking about negative things. So it's up to us to read the charts to see what we're looking at. So it's just the opposite of what happened in March of 2009. So whether it's going to turn out that way, I wish I had some cycles here, to tell you that that's what we were looking at. But frankly, we have some lunar stuff, but it's really they haven't been working very well. I mean, and as we know, when they do work, they'll work for 6 or 7 months at a time, and then they shift and they don't work for a little while. So that's what we have to be, aware of. That's for sure. So the next part that we want to cover is we've got a break coming up here, and I want to cover the. Someone asked a question about Apple. I hate to get back to this stock again, but if Apple does get down to this level of the 395, that's the number we're watching. What I'm going to be doing is I'm going to be watching some 440 or 450 calls going out about a couple of strikes, and maybe going out to probably this is March, April, probably to May. So to give it about 6 weeks. For it to work, and they'll be relatively cheap, I believe, because the calls will be, by that time everybody will be. I think Apple will get below 400, and that will cause a little bit of a downdraft, just because of an even number, and that's when you want to be looking to, to buy the calls, and and it's better to buy a call in Apple at that time because it does trade pretty actively, and so what I would suggest is, unless you can handle a $20 stop, which is 5% on the price of Apple, I would recommend you buying a call that's trading around $20, and it gives you more influence. Many of you were not around in 2009, but the stock that I picked was Apple. It was trading around $75 a share, and we bought a $90 call. And, of course, that $90 call went to $140, but it expired because of the contract of the call. But, those are the kind that you don't want to, you don't have to risk very much, because you want to focus on, how much you have at risk, not how much you're going to make. That's the secret to staying alive in this business and, being able to, take money out of the market, because that's the real key to doing this. So I think we have a break coming up here in a second. I wanted to cover. I have in my my chart portfolio here. I wanted to cover the euro, because we are at a real critical level in the euro also. Let's do the dollar index first before the break here. And because we are right at the ABCD 786 retracement in the dollar, and that makes it a head and shoulders pattern, folks, on the dollar index. So don't be surprised if you don't see a rally here in the euro, in the pound, and maybe the yen start to to sell off a little bit here, because this dollar index has gone up here and reached the level that we've been waiting for quite some time. And that's it's in a really important spot, this 83 level in the dollar index. And, it's been perfect. The bottom that we made in September was at 78.50, and the next low at 79 was a 786 retracement, and now we're at 786 retracement on the upside. So we have to, make sure that we're paying really close attention to the U.S. dollar at this time. This is a lot of things are completing patterns. There's just not just one or two things. It's telling you that there's just a lot of cycles that are, getting ready about going, and so we'll see. The euro is on the weekly basis. Oh, we're going to take a little break here. When we get back, we'll get back to the euro. 877-927-6648.
If you're an investor looking for a great weekly investment newsletter, then now is the perfect time to try out Ken Shreve's Ultimate Growth Stocks. Every Tuesday, Ken breaks down multiple sectors in his weekly newsletter, Ultimate Growth Stocks, with a full in-depth report including specific trading recommendations within his model portfolio, charts, sector analysis, upcoming economic data, along with intra-week trading updates on newsletter positions whenever the market dictates. Right now, you can receive a full month, that's 30 days, to evaluate Ken's newsletter free of charge to see if it fits your trading plan. At less than $75 per month, Ken provides you with his expert trading advice that can pay for itself in no time. Take advantage of this great offer by signing up for a 30-day free trial to Ken Shreve's Ultimate Growth Stocks today. Don't let this offer pass you by. Visit the front page of TFNN.com and sign up now.
with the launch of Tiger TV. TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, Ken Shreve, David White, Larry Pesavento, Victor Jones, or Carol Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's new trading newsletter, Patterns, Profits, and Peace of Mind. In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the forex market, and more. And you'll get the Technical Corner segment, which is a short but powerful weekly training session on trading. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you just the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 weeks. Go to TFNN.com and click on the free trial link at the top of the page. That's an $85 value, yours free when you register right now. Get Larry's Patterns, Profits, and Peace of Mind and get the edge you've been looking for.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Okay, we're back, folks, and I want to talk a little bit about the U.S. dollar index because we have reached some really strong resistance area up in this 83 level. We're only a few ticks away from, the exact price, but we do have some symmetry here with a head and shoulders pattern that stretches way back to last December. It's very symmetrical also, which is another factor that, is important when you're looking at a head and shoulders pattern. So don't be too bearish on the euro right now. That's just my opinion, but we should get some type of a correction. We've had a really good move in the dollar since we bottomed, in the middle of January. We went at least 5% higher, and that we went 10% higher, and that makes it a pretty good move for for anybody. And now we will be looking for a potential for a back off at this level. The euro is still bearish longer term. I posted the weekly chart into the Tiger TV, but the shorter term we could get a rally, only because this dollar index is 53% of the euro. So, it's weighted very, very heavily, with the euro. And then when you add the yen to it, you're talking well over 60% of it. And the yen has had a tremendous move, and we're into that level that we've been talking about for a long time, and that's that, 95 to 96 level in the Japanese yen versus, the U.S. dollar. So this is, something to keep in mind here. You don't want the yen has had one of the more bullish moves. I think how many weeks in a row? Out of the last 20 weeks, it was up. After 23 weeks, it was up 21 of the last 23 weeks. So that's been a tremendous move itself. The main thing to remember, from at least the way I see it, the game changer is the Treasury notes and Treasury bonds are heading lower. That means interest rates are going higher. We're completing all these patterns in the NASDAQ and the New York Stock Exchange Index and the S&P 500. And just because the S&P 500 gets into the new high ground, that really does not mean a whole lot, because that's a smaller index compared to the overall market. The big market is the Treasury bond market. It's 6 times the size of the stock market, and it is breaking down. We're looking at higher rates coming down the road here. So you want to keep that in mind also, because I think it's very, very important. And then, again, the U.S. dollar index is also reaching a level where we should see some, at least some rallying in some of the others. The other alternative here is that the U.S. dollar explodes out of here and goes above the 83.50 level, and this would be pretty much putting the euro down into the 128 level, and that would really scare some people in Europe, I believe, because then they'll have to start thinking about why the euro has not rallied very much. And if you look at that long-term weekly chart in the euro that I posted, that's not a bullish chart, folks. That has lower tops all along the way, 3 bearish-Gartley patterns that work nicely, and we are, we're still going down in the euro. That's the bottom line. So, whether this is going to continue or not, no one knows for sure, but we are definitely over some type of, and I've been saying this for a couple of weeks now, some really major cyclical stuff, because all these patterns are coming together in so many different things. So that usually means there's going to be some type of an event that is going to change people's thoughts, and that's it. I think it's the bonds, but who knows? Live every day in an attitude of gratitude, and may God bless.